Hey, everybody. Welcome back to our monthly market commentary for the month of June. I cannot believe it's June already.
Yeah.
I'm Brad Gatto, founder and CEO of Fiat Wealth Management. And here with me, as always, is Mr. Tim Holland, the Chief Investment Officer for Town Square Orion. Tim, thanks for being with us again today and taking another period of time out of your busy life to do a market
Oh,
commentary with us.
always good to be with you, Brad. Always good to chat with you. I don't think we're officially in summer yet. I'm not sure when the first day is, but I hope you and your family and your kids, hope you guys have an awesome summer.
Well, I appreciate that. Same back at you. Is that true, though? We're not officially,
I
like
don't, maybe
calendar-wise,
we
it's not
are.
summer yet?
It could
I have no
be.
idea.
See, you know,
In Minnesota, see, but I live in Minnesota. We don't follow that stuff in Minnesota anyway, because like 90% of the time we don't even get a spring. It's still winter,
yeah,
and then all of a sudden it's 90 degrees, humid with mosquitoes.
yeah,
And
yeah. No, yeah, those
fall,
mosquitoes are tough. Yeah,
yeah, we're getting blasted this year because it's been very wet. And
yeah,
so the
I
mosquitoes
bet.
are loving,
Yeah,
loving it. They particularly love my 11-year-old. I don't know what he
really.
tastes like to them, but
Yeah.
he's a magnet. So he's good to hang. If you don't want to be bit, he's great to hang
Yeah,
out
just
with because
stand
he's
next
going to
to
get all
him
the
and
attention.
maybe even
Yeah,
like do this, like just kind of point
he's right
that
there.
way. Yeah,
Yeah, he's
no,
right
my
there.
wife Meredith's the same way. Like they go nuts. Same thing. I don't know what mosquitoes. I don't know what flavor mosquitoes are getting there, but they just descend on her. So yeah, that can be tough.
So, any summer plans for the Holland family?
So our kids are big into lacrosse. So a lot of driving around. So we live outside of Philadelphia. So somewhere between like Long Island and Maryland is still kind of the hotbed, or maybe the most pronounced spot for lacrosse. So the first 6 weeks of the summer, whenever the summer gets here, it's all lacrosse tournaments and showcases for Grace and Spencer. And then our son, we were talking about this earlier. He wants to play football in high school. They start camp like first week in August or something. So I don't know if he
Crazy.
knows how short his summer is going to be. So a lot of lacrosse, then football, a week at the shore, as we call it, not the beach. And over here it's the Jersey Shore, not the beach in between. So how about you guys?
It's baseball. At least the
Okay.
first 2/3 of summer for us is baseball.
Yeah.
I think we have between my two boys practices, games, tournaments. We've got some baseball activity going on 28 or 29 of the days in June, something like that.
Wow.
Um, so
Man.
we're baseball. Hope to get some rounds of
Yeah.
golf in. But summer in Minnesota is like 4 days, so we'll enjoy it while we got it. All right,
That's good stuff.
let's jump
Okay,
into
sorry. Yeah.
the commentary for the month. If this is the first month you've ever joined us, we always have 3 points that we go through. One's a look back, what happened over the last month. One's a look ahead, what's coming up in this month in front of us, and then just a fun data point worth discussing. And so let's start with a look back. I'm calling this point, Tim, must
Yep.
be 54 inches tall to ride. We've
Okay.
all we all know what roller coasters are, right?
Yeah.
And I would call them the big boy roller coasters. If I remember right, and somebody might ping me on this, I think 54 inches tall is like the big ones. Like if you want to go on like the biggest roller coaster at the amusement park, I think 54 inches is
Yeah.
the deal. And so lately, over the last, I'll call it 8 to 10 weeks, it's been a bit of a big boy roller coaster. We talked about this in last month's market
Yeah.
commentary. April wasn't a great month. And then we got into May, and it was very volatile. Now, net may ended up being a positive for us.
Yep.
But just talk to us a little bit about what's going on the last couple of months and why we seem to have like this roller coaster ride going on.
Yeah, yeah. And before getting to that, do you like roller coasters? Do you
Love
like to
them.
ride them? You do? Yeah. I think I did. And then we went to Hershey Park a couple years ago. It's like 2 hours from where we live. It's the sweetest place on earth, which smells like chocolate out there. It's a great
Yeah.
time. And I went on some of these rides with my kids, and I was like, I like took a coward pill at some point between like my college years and my 50s because I was anyway. So no, good for you. I'm done with that
Love them.
stuff. So in terms of the volatility, and at the risk of going over ground, we keep going over because the story remains like inflation, the Fed, and the direction for the economy. But it was all of that, and then some in May.
Yep.
In that April, to your point, was off 4% plus on the S&P. It was a really bad month for the S&P. And then what happened was we got a disappointing jobs report for April and early May. and people felt good because like, okay, the economy is slowing, the labor market's weakening. That opens up the door for Fed rate cuts, and the market rallied sharply the first 2 weeks of the month. Then we got some data points that spoke to the fact that, oh boy, maybe the economy is hotter than we thought. And then the last day of the month, we got the Fed's preferred inflation gauge, the personal consumption expenditures index on the 31st. And that came in line with expectations. And boy, if the S&P didn't almost gain 1% on the day. So, you know, the things that have been driving the markets, the focus of our conversations remain inflation, the direction for interest rates, and how economic growth will either pull forward the day when the Fed can first cut or push it out. And so that was the story in May for sure. But on balance, we ended up, as you also noted, recouping everything we lost in April and then a little bit more. And so as we sit here, you know, early June 7th, sort of knock on wood, you know, we're up about 13% on the S&P year to date. So far, 2024 is off to a really good start, even with all that volatility you talked about.
Yeah, it's hard to get it's hard to have the perspective of the big picture when in the middle of the roller coaster you feel like you're going to die.
Yeah, which is why I don't ride them anymore. Yeah.
Nobody on the way down the first drop, because every roller coaster is the same, right? There's that first really big drop, and that kind of gets the whole thing moving.
Oh man, yeah.
Nobody in the middle of that first big drop is going 99.99% of the time.
Yeah.
Everybody that rides roller coaster lives like 99999, right?
No.
That's not what you're thinking.
Yeah.
It's panic. I'm gonna die. It's different this time.
Some of us are actually shedding tears at that point.
Yeah, that's why they put those cameras there, so they can catch you shedding those tears on the way down. So I appreciate the perspective, and it is a little bit of a redundancy, which is, so that's a great transition into the look ahead, what's coming up. And the name of this point, which I think fits really well, which is like me patting myself on the back because they're my names, is I hope you love reruns.
Yeah.
So I'm going to ask you this.
Yeah.
There's always, we're in the age of content, right? You can go to Netflix every single day and watch new content. And I don't know that you would ever get through all the content that's constantly being pumped out.
I bet.
But if you could never watch new content and you had to pick a rerun, something that has already come out, what would be your top rerun choice?
I think my favorite show of all time has got to be Cheers. Sam Malone, early 80s through the early 90s, Woody Harrelson. I'm going to go, if I only had one, Happy Days would be a really close number 2, but I'm going to go with Cheers. How about you, Brad?
I love that you have a 1 and 2 because I that gives me the right to do that. I feel like
it's your video. You can do.
This is I'm probably gonna get made fun of for this too, but I watch. So every night when my wife and I we have a TV in our room and I fall asleep to the TV. 9 times out of 10, it's on Friends, the show Friends.
Okay.
Because it's on rerun every night on Nick at Night. Like, just like clockwork when I want to go to bed, which is like 9:30.
Yep.
It's on. Me too. And so it's that's the easy like background noise as I fall asleep. So it'd either be that or Seinfeld. I love Seinfeld as well. I think
that's such a great show. And for what it's worth, so our daughter Grace is 17. I think she's streamed and watched Friends all the way through like twice. So I mean, I think that I think that show's still obviously
that's pretty good because it ended prior to her even being.
Yeah, no, born. I think it's still really.
That's how old it is already.
It's super popular.
We talked about this offline. I grew up watching Nick at Night, which back then was Mary Tyler Moore Show, which I have to reference because I live in Minneapolis now. So I grew up watching that. I Love Lucy, the Dick Van Dyke Show, Bob Newhart, like that kind of stuff. And so MASH, I still think that's great TV, but
great TV.
More of a Friends Seinfeld guy. So reruns, let's get back to this.
Yeah, sorry, go ahead. Yeah.
The reason I'm calling it a rerun and a look ahead is because here we go again. We I don't feel like have kind of a clear picture or answer of where anybody thinks the economy is going. Yeah. And it's all seems to be stuck on this idea of interest rates and what is the Fed going to do, and which is why these data points that we're talking about seem so heightened, and everybody's so sensitive to some of this inflation data and jobs data. So long story short, the Fed has a meeting coming up. So let's talk about that.
Yeah, no, I think you're right. I mean, the market's always going to move off of big data points, the unemployment rate, the jobs report, purchasing manager indices, inflation prints. But I think you're absolutely right that this market is particularly sensitive to those data points because the Fed has said it's particularly sensitive to all those data points, right? Jay Powell, the chair of the Fed, goes on and on about, we are data dependent. And so that's why I think, people are scrutinizing all this information in a way that is even more pronounced than they normally do. So as we record this video on the 7th, we just got the May jobs report, which came in hotter than expected. The April jobs report came in weaker than expected. What's interesting, at the risk of jinxing it, it's about 1:30 Eastern time as we talk, is that the bonds are selling off a little bit because the labor market's a little hotter than expected, but equities are catching a bid too. So again, not to get too short term, the narrative today is maybe we are kind of coming into this soft landing, right? This best of both, best of all possible worlds. But back to your point, the Fed meets June 11th and June 12th. All Fed meetings are important. This one's a big deal because coming out of this meeting, we'll get the dot plot, the summary of economic projections, which is what the Fed's members think inflation and GDP and interest rates will look like going forward. The last time we got one was in March. The Fed had still penciled in 3 rate cuts. No one's expecting 3, but 2 is going to land better than 1. And then we have to take all of that with a huge grain of salt because the data that comes out over the summer will then move those expectations too. But the big news is the Fed in about 5 days and what the Fed expects interest rate policy to look like this year. If I was a betting person, and I'm not, I would think the Fed's going to pencil in 2, but some folks would take the under on that for sure.
Yeah. So you made a great point. And there are definitely big pieces of data that are going to drive short-term movements and volatility in the market. Yeah. But again, every time you zoom out, the stuff just kind of evens out over time. So we got to continue that perspective, which is exactly what we talked about in point number 1, because you look at the last handful of weeks and the market seems very volatile. You zoom out even just to this year, which is still a very, very short amount of time. Yeah. And markets look great. Yeah. The markets look great in spite of, coming into the year, now tying this back to the Fed, coming into the year with the expectation the Fed's going to cut 3 times. The market was expecting the Fed to cut 6 times. And now here you and I are talking 5 months later of like maybe 1 to 2.
Maybe 1 to 2.
And in spite of that, we've got a 13%, snap a chalk line gain on the S&P. So pretty resilient markets.
I like the chalk
that
line
leads us.
I like the chalk line reference. Do you do any contracting, any construction work growing up, or you just?
I did. So my dad has done it in the past. My grandfather was a contractor. My father-in-law was a contractor. Yeah. And I had a couple summers where I roofed houses and a couple other summers where I was doing remodel work. So I've done it. I wouldn't say I'm good at it.
Yeah, roofing houses is tough. I didn't do that. I did.
That was terrible. That was terrible.
Hard. That's hard work. Yeah.
Yeah. And it was not good. And it was in rural Iowa where most of the houses that we were roofing had like 2 to 3 layers of old shingles on them already. And most of them had a layer of shakes. Remember those? The old wooden shakes underneath. Anyway,
good for you.
I digress.
No.
A data point worth discussing. I'm calling investing horoscopes.
Yeah.
Simply because everybody's kind of narrative around the timing of the year, the calendar, and based on the calendar, what the market should or should not be doing. And so there's this adage of sell in May and go away. That the market's going to have their run in the beginning of the year. Everything kind of quiets out. And the markets don't tend to perform very well in the summer months. And so there's been this adage. And so I want to talk a little bit about timing around calendars and data around that. But I'm going to throw you a curveball.
Yeah.
Okay. And I'm going to add something in, and I purposely didn't prep you for this.
Okay.
So I got an email from a client, and I'm just going to kind of give you a little context to this email, and I want you to incorporate that into this discussion of like calendaring, timing, and looking at a data point or 2 and using that to kind of determine markets moving forward. The name of the article that was read that the client was forwarding on is "No Turning Back," which is in quotes. And then after that, it says, "This Wall Street bear is predicting the biggest market crash since 1929. Wow. Here's how to prepare your portfolio if he's right."
Yeah.
The guy's name is Mark Bitznagel.
Yeah.
No idea.
Yeah. Maybe.
It's a credit bubble basis set to pop. He tells Bloomberg, blah, 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 greatest credit bubble in human history.
Yeah.
That kind of stuff. So I feel like we're getting more and more of these types of headlines
Yeah.
based on, and they're grabbing one or two of these data points. We keep talking big data points and using that to build their narrative.
Yeah.
And so when you're looking at the narratives that are built around the calendars of the month, sell away and going, sell in May and go away,
Yep.
or the narratives around the timing of the presidential cycles,
Yeah.
or picking a big data point like Mr. Mark Spitznagel did,
Yeah. Yeah.
and running with it. Just talk to me a little bit about that.
Yeah.
Your thoughts on
Sure.
that.
Yeah. So sell in May and go away, right? The 6 months kicking off with May have historically been a bit weaker than the 6 months kicking off with November, right? If there's any rhyme to that reason, right? So everyone in our business, right, would love to have the proverbial crystal ball, and it doesn't exist, and I don't think it's going to get invented. So people lean on history, they lean on patterns, and I think some of that can prove helpful. So the sort of the seasonality pattern really ties back to the idea that going into year end, professional portfolio managers tend to lean into risk. They'll buy more stocks, put cash to work. And then early in the year, sort of January and February, you have a lot of 401k inflows and people getting tax refunds and investing. And then maybe you get to the summer, things get kind of quiet. The world's sort of the markets have sort of become much more dispersed. But in the old days, all the big traders were in New York City, and they all went to the beach for the summer, and they were a little more volatility and not as aggressive in positioning. So I think those are the things that kind of roll up to that sort of idea, sell in May and go away. Though, as we were talking earlier, July has historically been, the second best month, I think, in the history of the S&P. So that falls right in the middle of that. The presidential calendar being that the third year of a president's term has historically been the best for the markets, regardless of what party holds at the White House. And there, the idea is if you're sitting in the White House and you want to get reelected, you're going to do everything you can to juice the economy into the back half of your term. If you're going for reelection, or to help whoever is the standard bearer for your party, if you've already served or you're serving out your second term, and that's proven remarkably consistent. And last year was obviously a great year for risk assets after a tough 2022. And then to your point about this fellow calling for the biggest collapse since the 1920s, I think as markets move higher and do well, you tend to get more frightening calls because people are maybe a little anxious because their portfolios are doing well, they're happy, but at the same time they worry, things don't go up every day, all day. And so I think these headlines, these calls become a bit more pronounced. If you think about market collapses, there have been a couple, three in the history of the market. One would be 1929, when you had not just massive speculation and people buying on margin, but you had no regulatory construct. The markets were a wild west. There was no SEC. People were doing all sorts of untoward stuff. Then you go into the early 1970s, you had a vicious bear market over the course of a couple years. You had stagflation, an Arab oil embargo, and the U.S. on the tip of deindustrialization, which was just a really, really tough stretch for our economy. And then you fast forward to 08 and 09, when you had the biggest residential real estate bubble in the history of the country, and you had to deal with that. And the S&P was off 48% at one point, peak to trough. If you look at the markets today, not to pick a fight with this fella, but corporate balance sheets are in fantastic shape. Markets are expensive, nowhere near where they were in the late 1920s or the early 1970s. You could argue that outside of some pockets of commercial real estate, residential real estate is in very good shape, and that's the most levered asset class out there. And on balance, U.S. investors have been net sellers of stocks for the last 7 years. So I see some pockets of excess, but I don't see a speculative mania. But one thing I've learned studying market calls, I hope I'm not going on too long, is that there's never any downside for making these incredibly bearish pronouncements, because you make it, you get some press, it goes away, it doesn't happen, and then you wait 6 months and you do it again. And then if you ever walk into an 08 and you happen to get it right, you're famous. And then you should probably never make another market call again, because if you look at all those guys in the Big Short, very smart real estate investors for sure, just about every one of them who's remained in the markets has gotten just about everything wrong since. So I always take those with a huge grain of salt. And then the final point about sort of trends in history and seasonality, markets go up about 80% of the time, 90% of the time. So history is certainly on our side from that perspective.
Great answer. I greatly appreciate it. It's one of those things where, and here's why I asked that question and kind of threw that in there, is because, and I'm guilty of this too. It's the whole, let's just say you and I were flipping a coin, which you and I both know that if we're doing a coin flip, there's a 50% chance it lands on heads and a 50% chance it lands on tails. And you and I are betting on this every single time, right? Heads, tails, heads, tails. And 10 coin flips in a row, it lands on heads. What are the odds that on the 11th time it lands on heads? It's 50%. It doesn't feel that way.
No.
Because in your head, you're going, well, what are the odds? It can't happen again. The odds have to be in the favor of tails. No, they don't. It's still 50-50, even if it happens 100 times in a row. And so when you look at the markets, to your point, you go back to 08, 09, it's a lot easier today to look at and have a position like this Mark guy does. Don't even know who that is, but this Mark guy, and say, hey, it's going to come down. And for people to glob onto it and go, gosh, it seems like, he might be right, because we've been on a heck of a run. We've hit heads, an abnormal amount of times. And so the odds got to be in the favor of tails. No, they don't. The odds are still in our favor that any bear market prediction is wrong, to your point, ever. So, and I think it's a really important point that you brought up too, that the systems and processes that we have in place, the protections today versus, the economic collapse of 2029.
I don't think
it's just important.
I don't think anyone, as fascinating as that history is, and you could argue that what FDR did was too much, not enough, sort of the regulatory construct he put in place and sort of the role of government in the economy, which radically changed when he was elected president. You can argue the pros or cons of that, but I think anyone who sort of draws parallels to the late 1920s and the early 1930s to make the case that we're going to experience something similar when you have things like the FDIC, right? You have the SEC, you have unemployment insurance. I mean, none of that stuff even existed. And so
Social Security, Medicare, Medicaid.
It's apples it's apples and oranges when you think about the natural, the inherent buffers that are now in place at the state and federal level to support the economy and the consumer and spending that just didn't even exist 80, 90 years ago. So that's always, for me, that's kind of a silly parallel to fascinating history, but I don't think you can use that as a jumping off point to make a point about today. I just don't think they line up at all.
I would agree. And I would also tell you this, and we'll end by and if you've all stuck with us, we're a little long-winded today. So thank you for sticking with us. But that being said, I'll end by saying in our planning here at Fiat, we are never picking out any of these isolated data points or trying to guess when we think these, although they're the minority of years and seasons in the market's lives, we're never trying to guess or pick out these bear markets. If you're going to invest, right? It's the old Warren Buffett adage of get invested and stay invested. And the reason Warren Buffett is who he is because he buys into companies that he believes in and he sticks it out in spite of the thin times and through the good times. And so good financial plans, that is the crux of where your value comes from in an advisor relationship. In fact, Vanguard just re-released a study they did 20 years ago. They updated it. And Vanguard's estimation through this white paper, they say there's about 3% value in working with an advisor. 2/3 of that, 2% of that it has nothing to do with the portfolio construction. It has to do with behavior and basically saving clients from themselves. And so, Tim, it's always awesome. Thanks for being here for the June monthly market commentary. We'll see you back in July. And until then, enjoy lacrosse with your kids.
Enjoy baseball. Look forward to connecting with you next month.
All right. See you, Tim.
See ya.